All right, welcome to this week's Feedback Friday video, where I take the best question each week from the Market Pulse Discord and turn it into a short trading video. This week's question is about how to gauge the health of the overall market. The user asked, what methods do you guys use to assess the health and the current status or cycle of the market? NAAIM, breadth, etc. And what is your process like for checking these, and how do you think about them individually or holistically? How do you use them to make predictions about what is likely to happen in the near future? And what standard methods are you employing with your trading as a response to these circumstances? Just a phenomenal question, and we'll go through a couple different factors that I look at when it comes down to the health of the market, including the price cycle of the indexes and ETFs, the action of the liquid leaders, how earnings results are coming out and the risk appetite around that, and then the argument between positioning and sentiment, and finally, the feedback from your most recent trades. So I'll turn off the camera so we can see the full presentation and we'll get into it. So first off, why is it important to understand the market environment? When you have a good pulse on the overall health of the market, you're able to optimize pieces of your system with very small tweaks. That could be the setups you take, the size that you trade with, or how quickly you take profits. First up, we have the price cycle. And when I'm going through my indexes or ETF lists, I'm trying to put each of them in one section of this price cycle. So this is a graphic that Oliver Kell made with Trader Lion. This is his kind of price cycle that he uses that I've adopted. And it really just determines whether a stock, ETF, whatever, is in an uptrend or a downtrend. And we'll just start with the downtrend. At some point, the stock's in the downtrend. You'll see a very large push lower with a pickup in volume typically. And as people are panicking out of that stock and eventually other people are stepping back in, you'll get what's called a reversal extension, where you bounce back up to the moving averages. Oliver uses the 10 and the 20 EMA. I do the exact same because I learned this from him. We rally back into those key moving averages, start to build out some higher lows, and then have what's called a wedge pop, where price goes through both the 10 and the 20 day, but more so just through the recent consolidation. So it's much more about the price consolidation that you're popping through versus the kind of moving averages. But that wedge pop really signals that the trend has changed from a downtrend into an uptrend. From there, the first time you pull back to the moving averages, typically when the 10, or sorry, yeah, when the 10 is crossing back over the 20 day, you'll get what's called an EMA crossback. That's just kind of like the first consolidation after the wedge pop. And then each consolidation from that point are called basin breaks until eventually you get the opposite of a reversal extension. You get everyone piling in the market or the individual stock. This is typically seen with multiple unfilled gaps to the upside, large volume, very large extension from the shorter term moving averages. And then as typically retail traders are buying the top and institutions are starting to liquidate positions for nice profits, you'll get this exhaustion extension. We'll pull back into those moving averages, put in a lower high, and then what's called a wedge drop, where you drop back through those key moving averages, starting the downtrend where you had that same EMA crossback, a basin break, and then reversal extension. So I use that price cycle on not only the indexes like the NASDAQ, S&P 500, and then some key ETFs like IWO, which is the growth stocks of the Russell 2000, ARKK, and Bitcoin, but I also use it for industry ETFs. And if you're not very familiar with the price cycle, that's something that you can learn. But a pretty easy kind of check for me is the ETF or index above the 20-day EMA, or is it below? And if it's above, is it trending neatly above? If it's below, is it trending neatly below? Or do we get some chop like back and through the 20-day EMA? So if the NASDAQ and S&P 500, IWO, ARKK, if those are all above the 20-day EMA, for me, this is a healthy market. And a vast majority of my positioning should be on the long side. I should be trying to hold winners for larger moves. I could be more aggressive with my position sizing because, in general, that is a key of a stronger market. Now, if you're chopping below, like back and forth between the 20-day EMA with those indexes, maybe you have to lower position size, take a little bit quicker profits, and then just play a little bit more defense. Maybe try out the short side if that's something that you're comfortable with to kind of balance out your portfolio. Another thing that I'll check is with the industry ETFs specifically, is the number of industry ETFs or themes that are participating in the uptrend increasing or decreasing? Most recently, we saw a lot of these start to decrease. We saw the indexes start to have some unfilled gap downs. And that was just a sign that the market was starting to feel heavy and to reduce longs, maybe start some shorts. Um, and that's kind of like how the most recent week has played out. But you definitely want to be aligning your exposure with the leading themes in the market. That's something that I tend to repeat every video, but it is very important. Next up, we have tracking the leaders. This is something that I've learned from Ross Haber, who he always, every time I talk to him, he's like, what are the leaders doing? What are the leaders doing? What are the leaders doing? Because really, the goal of swing trading is to be in the liquid leaders of the leading themes. And if you're doing your job, it doesn't really matter how like weak the market breadth is, because a lot of the times as market breadth weakens, you'll see money rotate into a smaller group of stocks to keep them afloat. And those are the stocks that you want to be in. So because you're getting stopped out of names because market breadth is weak, doesn't necessarily mean that that's a market that you can't participate in, but you need to narrow your focus on the groups that are working. Let your stops take you out of the positions and the themes that are no longer working, and then just continue to focus on the leading stocks, the liquid leaders in those leading themes. And then in general, if the leaders are showing relative strength, so if the leaders are not breaking down while, say, the indexes are breaking down or industry ETFs are breaking down, then overall, you should still stay positive as long as I would say the NASDAQ and S&P 500 are over their 200-day moving average or over their 50-day moving average. If the leaders are acting okay, try to stay bullish because over a very long period of time, the majority of the time, the market goes up and the liquid leaders will go up way, way more than you expect. This is something that I struggle with, and that's kind of why I'm hammering it home right here. But if the leaders are showing relative strength, even while the market is choppy or in a downtrend, try to stay positive and be focused on getting exposure into those leaders. Now, if the leaders are breaking down, that's when it's really time for defense. And typically, you'll see this like towards the end of the cycle because you'll always have some stocks that are acting okay, typically, unless it's a true bear market. But if you're switching out your leaders list very often, that's kind of a sign that, hey, some themes are breaking down. Maybe it's time to play a little bit more defense, lower your position sizing on new trades. And then one thing that I do is I've got a dashboard in Deep View with the 9 liquid leaders in my eyes. And this is a list that I can change. Like, eh, I try not to change it every single day, but usually like once a week, I'll make a change here. And just very simple. I got the 10-day EMA, the 20-day EMA. Are these leaders acting well? Are they above their 10 and their 20-day EMA? Are they chopping between those moving averages? Do we see heavy volume breakdowns? All those quick things you can see with just this quick snapshot. Next up is the risk appetite around earnings reactions. I think this is particularly important because we're right in the middle of earnings season right now. But really, this kind of falls into 3 different categories for me. If stocks are beating earnings expectations, earnings and revenue expectations, are they gapping up and following through to the upside? So not just like one day where it gaps up, but do we see persistent demand and persistent risk appetite? If that's the case, that's something that I think about and say, okay, not just one stock, but multiple stocks or multiple themes have stocks that are breaking out on earnings and not just going up for one day, but actually following through to the upside. Institutions, they have strong risk appetite. They're going to continue to build into those positions. And those are uptrends that, for the most part, we want to ride. Or do stocks that have strong earnings gap up, but immediately sell off? Or even worse, do they gap lower on solid earnings? So Palantir this year or this quarter, 200% earnings growth, 62% sales growth quarter over or year over year for that Q3, and it actually gapped down. And at that point, you're kind of saying, okay, this is the best news that Palantir could have had, and it's gapping down. This might be a little bit later in the cycle for Palantir because it seems like this has been priced for perfection. And then the third option is, do stocks with poor earnings actually rally? So if stocks that might have poor earnings, but they guide the next quarter really well, and institutions are fine with that, then that's a signal that this is a risk on market and institutions have strong risk appetite. Next up, we have positioning. And for me, this falls into two categories or two things that I look at. The first is the NAAIM, Active Investors Exposure Index. So this is actual positioning. This is not just sentiment, but actual positioning of active fund managers in US equities. This updates every Thursday, usually like an hour or two into the trading day. And the data is as of Wednesday's close. So it does give you like pretty quick feedback with that exposure level. And for me, this is something that I've used for a couple years now. And whenever this is above 95%, I start to get a little bit more cautious. I don't tend to buy breakouts. I, I'm trying to collect evidence at that point that, hey, if everyone is already in the market, who else is left to buy? And in that type of environment, a lot of the times you will see stocks like either gap up on earnings and immediately sell off or gap down on strong earnings because everyone is already in the market. They're going to be using liquidity to sell into. Another sign that I look at when we get to these overbought levels is, are clean pivots quickly breaking to the downside after a like short uppercut. So you have a nice clean pivot. SoFi comes to mind this week, where we took out that daily high. Everyone bought as we took out the daily high, and then within a couple minutes, we immediately reversed and fell lower. So they were using a point in the chart where there was additional liquidity, either a pivot point, a previous high, key moving average, stuff like that, and they're using that liquidity to de-risk and reduce their positioning. And in markets like that, it's really tough to gain traction if you're buying stuff on strength. Once we're over 95%, I almost only will buy pullbacks to key moving averages or support gaps. Breakout buying does not work as well. And then on the flip side, when you see this get below 60%, and as long as there are quality setups, it's time to be aggressive because if these active investors are only 60% invested, there's plenty of money on the sidelines that can come into the market. And it typically doesn't go from 60 to 100 in a single week. It takes them weeks and weeks and weeks to build in. So the first couple stocks that are breaking out into new highs, when you have exposure less than 60%, or even in that like 60 to 65 range, you can be pretty aggressive with positioning and try to hold for much larger moves because there's just so much money on the sidelines waiting to come in. And the nice thing that I like about NAIM, which I'll put the link in the comments here, you can download all of its data from, I think it's 2006 to present day. So you can do your own historical analysis on this and come up with your own thresholds, but really a good a report that I look at every single week. The other positioning report that I look at is the COT, Commitment of Traders. Now, recently, this is very unfortunate, but it has not updated because of the government shutdown. So when the government comes back, hopefully we'll get this back. But for the meantime, we do not have the Commitment of Traders data. I just go to barcharts.com to get this. I'll link this as well. And the lines here at the bottom is what you're looking at. You've got your small speculators in purple line, which you kind of definitely want to fade. Your large speculators in the green line. And really the combination of both of those on the flip side is your commercials, which is the red line. And you want to align, not always with exposure wise, but mentally, you want to align with what the red line is doing. So, or sorry, yeah, with what the red line is doing. So at one point we had back in late August, we had exposure extremely along the Nasdaq for your small speculators and large speculators. meaning if everyone is very, very long the NASDAQ, chances are you're not going to get trending action out of that. It doesn't mean that you have to dump. It doesn't mean that it's the start of a bear market, but it does mean that you're typically going to have more frustrating time trying to build exposure at that point in time. And if you look at the chart, once we got to those overextended levels, where if you're in line with the commercials and against the speculators, we basically chopped sideways for 4 weeks with a lot of frustration. I remember in this time trying to get positioned on the long side because everyone was already long. And the thing I like about COT data over NAAIM data is it's very, very granular. You can see this for a bunch of different futures markets, grains, if you trade that, currencies. You can also see the S&P 500 versus the Nasdaq versus the Dow versus the Russell 2000. So a really nice way to look at some of these markets where it's not just saying, okay, US equities, you're 100% exposed. All right. You really get a nice granular look at this. Now, the downside to commitment of traders data, COT data, is it comes out Friday after the market closes when the government is open. But the data is as of Tuesday's close. So it is a little bit delayed, about 3 days there, where an AAIM, they collect the data Wednesday as of Wednesday's close and they report it Thursday morning. When it comes to sentiment surveys, I don't care about those. I see the CNN Fear and Greed Index posted on X and Twitter, whatever, all the time. It never means anything to me. I don't really care how people feel. I want to know what they're actually doing with their money. And I'm sure there's a way to build an edge in the market around this or some other sentiment surveys. But for me, it's not part of my process. I've never seen any success with it. So instead of trying to figure out like another thing to add, I will use actual positioning because that's what actually matters to me. And speaking of what actually matters, the most important thing when it comes to gauging the health of the market is your feedback of your last couple trades. And I have last 10 trades on here, depending on the time frame that you trade in. This could be up to 20 trades, it could be last 5 trades. But I think 10 trades is kind of a good pool to work with. And then take a look at your stats over those 10 trades and compare them to normal. Is your win rate above your average win rate? If so, that's either a strong market or you're seeing the ball well, and you should continue to press on whatever you're doing. Is your average hold time lower? Now, this would happen in typically a choppy market where you're trying to get positioned and then you get stopped out very quickly. Or you get one day up, you take some profit into strength, and then you get stopped on the rest. If your average hold time is lower, chances are the environment is a little bit more tougher, at least for swing trading, and you should be probably using different entry tactics instead of buying on breakouts, buy on shakeouts. I did a whole video on that. I'll put that in the comment section as well. You should probably look to take profits a little bit quicker and then play defense a little bit more. And then which side of the market, long versus short, are you getting better results from? The last 3 weeks, it was very, very easy to make money on the short side for me. And then every single trade, not every single trade, I think I had like one or two winning trades on the long side, but a vast majority of my trades on the long side the last 3 weeks have been losers. And I took that market feedback and said, hey, the long side is not working. I will be reducing my position size if I'm trading on the long side. I'm only going to be trading undercut and rallies if I'm trading on the long side. And I can focus on the short side because that's what is getting traction. And the most important thing is, are you profitable? If you're not profitable over your last 10 or 20 trades, you need to slow down. And this is something that the best traders do extremely well. And the worst traders and new traders, they tend to fight this. Instead of sizing down when, or instead of sizing up when you're on a losing streak and you're trying to get that money back on your next trade or your next trade or your next trade, size down until your strategy is right, the market is right, or some combination of that too. Because the only way you lose money in the market is you're not seeing the market right, you're not trading the right setups, or the market itself is just not strong enough. And either way, you don't want to be pressing the gas in those situations. So all of the things that I've gone over today, I kind of look at holistically, but the by far the most important thing is the most recent trades, the feedback that you get from that. So that's going to be this week's Feedback Friday video. I hope you guys enjoyed it. If you did, leave a like and subscribe to the channel. If you have another question and you're in the Market Pulse Discord, make sure you're using that question and answers section of the Discord so I can pick on you for next week's video. And if you're not part of the Market Pulse Discord yet, consider joining. The link is in the comment section. Hope you guys enjoyed it. Leave a like, subscribe to the channel, and I'll see you guys in the weekend prep video that comes out tomorrow, where I'll be going over basically everything that we've covered in today's video. Have a great night, and I'll see you guys tomorrow.